a lot of the silver buying, ETFs is one thing, but the physical silver buying, I think much of that, once it's purchased, it comes off the market and it's going to stay off the market for a long time. I think, you hear about these silver stackers that buy and buy and buy and never want to sell. Ultimately, eventually, they will sell. Some will sell earlier than others, but I think on average, for the most part, we're only going to see that silver come back to market at considerably higher prices. I think we need to be, somewhere near 40 and well north of 40 before that starts to come back to market. It'll probably even only trickle in. So I wouldn't look to that to help meet deficits anytime soon. So for me, that helps paint a very, very bullish picture on the supply-demand aspect.
Gold has reached new all-time highs and sustained them 3 times, demonstrating remarkable strength in its uptrend. Historically, gold has tested its 200-day moving average after each breakout or come within 2% of it. Following these tests, both gold and silver have experienced significant gains. The smallest of these rallies saw gold surge by 80% over 18 months, while silver skyrocketed by 228% in just 14 months. Such a performance could repeat itself into 2026, but only if a fundamental shift occurs in the market. The potential for this shift is well aligned with 2 crucial technical developments. Gold, when measured against the 60/40 portfolio, is on the verge of breaking out from a decade-long base. Simultaneously, gold's performance against the stock market is approaching a breakout from a 4-year-long base. These long-term formations suggest a substantial gold revaluation relative to traditional investment assets may be underway. PeterKrauth of Silver Stock Investor and Silver Advisor highlights gold's 40% gain and silver's 44% rise last year, outpacing the S&P 500's 22% increase. Investors seeking value may shift towards mining stocks and physical precious metals if equities weaken. The impressive performance of gold and silver in 2024 has been driven by a confluence of economic, geopolitical, and market factors that have created an environment favoring safe haven assets. As uncertainty persists, the appeal of gold and silver as wealth preservation tools continues to grow. Senior, mid-tier, and junior gold stocks are well positioned for a breakout following the subsequent market correction, historically benefiting from rising precious metal prices. Recent expectations regarding Federal Reserve policy have added complexity, with current probabilities suggesting a 50-50 chance of rate cuts at the May meeting. This is a shift from last week's 75% expectation of unchanged rates. Krauth emphasizes that if the Fed cuts rates while inflation is high, it could damage its credibility and drive more investments into gold and silver. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
We touched 35 last October. We had a huge run-up from February. I think it bottomed around 22, ran to 35. That's like a 40% gain. Not surprising to see these gains being digested right now and the silver price to kind of move sideways and consolidate. But, the market is so tight, and I think that was one of the reasons that we saw that big move is the market or the participants are starting to see the tightness and the expected ongoing tightness. That was one of the things that got silver to start to move so much. That's not gone away. If anything, it's gotten tighter. So I think that to revisit 35 is very realistic and likely in the first half of this year. I think you mentioned the Fed before. The Fed likes to say that they don't pay attention to U.S. debt and they don't pay attention to the level of interest payments in the U.S., for example, but they are off the chart. The U.S. is now paying more in interest to service its debt than they're spending in defense, and so that traditionally has been sort of a turning point for an empire, so to speak. And that's when we can expect things to continue to degrade. Sorry, losing my voice here, talking too much. The Fed says that they ignore that side of things. I don't believe it. I think that they cannot help but pay attention because it's a spiral for the U.S. Treasury to have to pay. And think about it: the higher interest rates are, and they have to renew a lot of. A lot of debt is coming due. They're going to have to renew it. Even if they renew it all at the shorter end of the curve, so short-term treasuries, we're still at higher rates in short-term treasuries. So as all of this debt comes due and they renew it, even at short terms and higher rates, they're going to be paying more and more and more to service their debt. So again, I cannot see the Fed ignoring that. They know it's, as I say, it's a spiral, a death spiral for the Treasury. I think that despite wanting to keep rates high because inflation is high, they're going to resume cutting probably later this year. And when you see them resume cutting, if this happens the way I think it will, in the face of sustained high inflation, they're going to lose all credibility. And I think that's going to be a really obvious trigger for precious metals. And you're going to really start to see funds starting to flow to the precious metals market and things start to move they've already done so tremendously for gold. You know, where were we a year ago in gold? 2,000 range or 2,800. We're looking at 40% returns. It's silver in the last year was up 44%. The S&P was up 22%. It essentially doubled the return of the S&P. So all of these indicators are suggesting to us that the generalist investors are starting to pay attention. The one, I think, big trigger that will make all of the difference is if we see general markets roll over. The S&P has been unable for several months now to take out its prior peak around, I think it was 6,100 or so in the S&P. We're at about 59 or so today. If we see it continue to stay weak and to continue to fall, you're going to start to see at least first the big money, the smart money that tracks all these different sectors, and they're going to move from what's been generating gains for them for the longest time, tech. They're going to start moving to deep value, and you're finding that right now in the mining industry. Fantastic stat that was generated by a friend and colleague at Tavi Costa of Crescat. He went and looked in his Bloomberg at if the gold miners in the S&P were a sub-index of the S&P to just see how they perform versus the rest of the S&P and other sub-indices. They are the single best performing sector of the S&P. 40% free cash flows. I mean, nothing comes anywhere close to that. I think that's going to trigger M&A. They're going to use this cash, and when the market comes in and starts to push their share prices up, they're going to use their shares as a currency to turn around and start buying up smaller players and replace their reserves. And that means investors can start moving down the food chain in the precious metals mining area.
Beyond technical factors, silver's strength is driven by fundamental catalysts shaping its market dynamics. Rising trade tensions between the United States, Canada, Mexico, and China have increased demand for the metal. With the U.S. imposing 25% tariffs on imports from Canada and Mexico and 10% on Chinese goods, affected countries have signaled retaliatory measures, given that China and Mexico are among the world's largest silver producers. At the same time, the U.S. remains a key consumer. These developments introduce potential supply chain disruptions and increased price volatility, adding another layer of support to silver's bullish outlook. Market movements have shown uncertainty, with silver prices fluctuating significantly. In early Wednesday trading, prices rose to $32.35 before retracting, highlighting resistance at this level. Short-term volatility is likely until silver breaks above $32.35, with traders capitalizing on dips. Despite these fluctuations, the overall uptrend remains intact, attracting investor interest. The supply-demand imbalance in the physical silver market supports higher prices as many long-term holders continue to accumulate. PeterKrauth suggests it could be at much higher levels when they sell, potentially around $40 or more. This gradual selling means supply deficits will persist in the near term, reinforcing the bullish outlook for silver amid rising demand. Let's get back to the interview.
Ever since now President Trump has been talking about imposing tariffs on other countries, and that is, for manufactured goods as much as it is for resources. There have been absolutely outsized historic amounts of metals flowing, gold and silver, from London, mostly out of London, where the larger inventories are, somewhat to Shanghai, but especially to New York on the COMEX. And so the thinking there is that anyone who needs to make delivery of silver in the U.S. wants to get its silver into the U.S. borders so that they're not slapped with tariffs. Because if you can imagine having to, pay 25% more for your silver from one day to the next, it could wipe out some banks, it could wipe out some traders, and so we've seen these huge flows of silver into the U.S. A lot of it is actually being taken in physical delivery. So it's not just going onto the exchange, but some of it's just going directly into large private vaults. So we've not seen this really happen before. The COMEX is not meant really for a delivery type exchange like the Shanghai is. And so we're seeing that, and if we can talk about gold for a moment, the LBMA is now saying that when normally it would take them a few days to deliver gold, they're asking for 4 to 6 weeks. So a colleague of mine, another newsletter writer, Chen Lin, is saying they're technically in default because they should be able to deliver, let's say, within at least a week or 2 weeks, and now we're well beyond that. They try to downplay it, but it's not that the silver is, there is a very tight silver market, we can get into that, but it's not that this is tightening the supply, it's just that it's shifting it around. And since a lot of it is being delivered to physical, to vaults, to private vaults, a lot of this silver is in some way coming off of the market, not being made available for delivery. And so just the end of, just saw the numbers for the LBMA, they had the single largest drawdown. It was something like 71 million ounces came out of the LBMA for the month of January. It was the single largest monthly drawdown they've had since they've been tracking numbers back a decade. So again, these are very big movements and something to keep a really close eye on because it's making the silver market very tight. And what we're seeing too is that traders and people who are consuming the silver, like industrially, for example, they really obviously need, in that case, especially the physical silver. It's not just exposure to the silver price one way or another. They actually need the silver. And so we've seen the premiums go up. There's something called EFP, exchange for premium. And the premiums to have physical silver versus owning the silver through a futures contract have gone way up. So all these participants are starting to really want to get their hands on the actual physical silver. And that's what, there's a lot of talk about a lot of silver being leased out, having multiple claims on it. This is really starting to squeeze things and get, the silver market to pay a lot more attention to what's going on. They're expecting industrial demand to come off a little bit. They're expecting, to go up, but they're expecting investment demand to come off a fair amount, and that kind of makes up for it. But what I found interesting is that if you look further down in their forecast, in these tables that they produce, they think that investment demand will actually be, and it's not included in the sort of the main numbers, but if you include investment demand, let's say, which would go, especially the investment demand that goes into silver ETFs, they've actually doubled their forecast from 50 million ounces of silver to 100 million ounces of silver. So if you include that, you're actually somewhere very close to the record deficit that we saw in the last 5 years. So again, it's how you look at the numbers. Some will argue that they don't want to include investment demand in silver deficits because technically that silver is always available to come back to market to feed supply. I'm not so convinced of that. I think that a lot of the silver buying, ETFs is one thing, but the physical silver buying, I think much of that, once it's purchased, it comes off the market and it's going to stay off the market for a long time. I think, you hear about these silver stackers that buy and buy and buy and never want to sell. Ultimately, eventually, they will sell.
As global markets evolve, gold and silver continue to assert their role as essential assets for wealth preservation. Gold's resilience at record highs and silver's increasing demand amid trade uncertainties highlight the shifting investment landscape. Both metals appear well-positioned for continued strength, with potential monetary policy changes and supply constraints adding further momentum. Investors are watching closely as market conditions set the stage for the next significant move in precious metals. Will ongoing economic and geopolitical shifts drive gold and silver to new record levels? Or will market corrections slow their momentum? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.